Hello and welcome to Crossing the 49th, the Cross-Border Tax and Financial Planning Podcast. I'm your host, Phil Hogan, and today we're going to be talking about RRSPs and how they relate to US expats living in Canada. Okay, so today we're going to be talking about RRSPs and how they relate to US expats living in Canada. Now, this topic's likely relatively straightforward for most individuals because most individuals know what RRSPs are. They have RRSPs. They contribute regularly to their RRSP. But I think it's a good idea to kind of walk through some of these ideas and examples, and especially for those that maybe are in their working years that haven't really started contributing, or maybe they built up some contribution room, just to revisit this topic, because RRSPs are certainly one of the best ways to minimize tax that we have in Canada, certainly. So let's just, a little intro on RRSP. So what is an RRSP? So an RRSP is a registered retirement savings plan, a Canadian plan that was really set up to incentivize individuals to invest. So how's the Canadian government done this? So really they're incentivizing individuals to invest by giving them a deduction for money that goes into the RRSP. So let's, for the purpose of this conversation, let's use some basic figures just to kind of outline this. So let's say you have an individual that earns $100,000 a year, and they've opened up an RRSP, and they want to contribute to this RRSP and get a deduction for tax purposes. So the way an RRSP works and the way RRSP limits work is as you work or as you earn business income, or really any earned income. So earned income would include business income, rental income, employment income. So as you earned income, you get an amount allocated to you for your contribution room. So that amount is 18% of earned income up to the maximum amount available above $26,000 per individual per year. So for those that have just moved to the country, you might not even have any RRSP contribution room until you start creating some via working or earning earned income. But let's assume that you have RRSP contribution room. So let's say you have an individual earning $100,000 a year that has $30,000 of RRSP contribution room, and they want to contribute something in that particular year to their RRSP. So, and let's choose $10,000 as the amount that they're going to contribute. So they earn $100,000 that gets taxed on their Canadian return. They contribute $10,000 to their RRSP, which is really a deduction for Canadian purposes now. So now their taxable income is only $90,000. So essentially they've saved tax on $10,000 of their contribution to their RRSP. And this is the incentive to get individuals to invest. Now, of course, there's other incentives to invest for individuals, but knowing that you're getting a deduction specifically for that $10,000 that you contributed to their RRSP, there's a reason why it's a very popular account in Canada. So when we talk about RRSPs and whether or not to actually contribute to these accounts, and we get this question all the time, should I be contributing to my RRSP? Because what we'll often see is we'll have individuals with fairly large RRSP contribution balances, and that's really the question. And of course, the answer to this question depends on the individual's situation completely, and it's hard to be general, but generally speaking, you're going to want to contribute to your RRSP and get a deduction at the higher income level. So once again, this is a conversation with clients, but if we know we have a young individual that's earning $100,000 a year, and they know maybe in the future they're going to continue to increase their earning capabilities, these are the years in which you want to contribute to an RRSP, because the idea is you contribute to an RRSP in your working years or in your business years, and you receive a deduction at a relatively high tax rate. So let's use some figures. So let's say an individual earns $100,000, $200,000, doesn't really matter for purposes of this conversation, but in income, and let's say their marginal tax rate is 30%. So their marginal or even average tax rate is 30%. So for every $10,000 they contribute to their RRSP, they'll get a 30% tax deduction or a 30% tax advantage. Right, so they'll be able to save 30% tax on that $10,000 or $3,000 on that tax contribution to the RRSP. Now, in retirement, and we'll talk about this a little bit later, once that RRSP converts to a RRIF and you retire and your income drops, that money is it comes out as minimum distribution. So you're forced to take a certain amount out after 71.5 out of your RRIF. And that amount will be taxed to you as straight income. And let's say in retirement, just for purposes of this conversation, that your tax rate's 10% in retirement. So now you take out that same $10,000 and you're taxed at 10%. So your tax on that amount is $1,000. So you got a deduction initially for $3,000. You paid $1,000 in tax eventually once you retired and moved the money out. And you've essentially saved $2,000 net tax on that contribution. So that's basically how the RRSP works. And that's basically the idea behind the RRSP and the incentive structure for contributing to the RRSP when you're younger and you're in your higher income earning years. And then in retirement, the idea is you draw down the amounts really to nil. Because if you pass away, unless you're transferring the RRSP to a spouse, that amount's going to be included in income. And it's interesting because I remember having a conversation with an individual, this is many years ago, where they were really trying to make the argument for not having an RRSP at all. And fair enough. I mean, I think that argument can be made if you structure a portfolio in a way specifically in maybe the heyday of dividend stocks, where you could develop a portfolio that was highly concentrated in eligible dividends that were taxed very favorably for Canadian purposes. And you did all that outside of an RRSP, and you could use an example. Let's say you had an individual that was earning $60,000 or $65,000 of straight dividend, Canadian source dividend income that would essentially be tax-free, and they could do that in perpetuity. So that's kind of the argument. But at the end of the day, the argument was being made because they were assuming that if you did contribute to an RRSP and you built up a sizable RRSP, I mean, this was the argument they were trying to make, that if you passed away, that full amount of the RRSP would be included in income and the government would take half of your account. And that's certainly true. If you've built up a sizable RRSP from, let's say, working age of 20 or 25, to 30, you're getting close to retirement, you're getting close to 70, you've built up a pretty sizable RRSP and you pass away, and let's say you assume that you don't have a spouse, that you can roll the account to tax-free, the government will take a big chunk of that account. But that's predicated on the idea that you pass away at 70. If you pass away at 70, all bets are already off. And that's the saddest part. The saddest part is you actually passed away, not necessarily you had to pay all this tax to the government. So I think we all have to assume that we're all going to live, or at least do our planning like that, because if you were to pass away that early at 70, that would just be a sad situation anyway. So to make the argument that if you pass away early, the government's going to take half your money, most families are only going to worry about the fact that they've lost somebody versus tax minimization. So I think we always want to assume that we're going to live past these years, because that's really when the tax advantage of the RRSP is really going to kick in. It's the difference between that high rate deduction that you're getting and then that lower rate of tax you're paying once you start pulling out the amounts once they convert to a RRIF. So that's the idea behind and the incentive structure for actually having the RRSPs in general. So very general overview, and we didn't talk at all about different structures for the RRSPs, like spousal RRSP. So, and maybe we can talk about that a little bit. What they do allow you to do is set up a spousal RRSP for your spouse. You contribute to the RRSP. You get the deduction for the RRSP contribution, but eventually your spouse pulls the money out in retirement, hopefully when it RRIFs. And the idea there was to be able to split income between you and your spouse. So the idea is what you don't want to have happen is have spouse A with $1 million RRSP and spouse B with no RRSP. And then within retirement, as the money's coming out of the $1 million RRSP in large chunks, it's only being taxed in spouses A's hands. And the spouse B is not able to take advantage of splitting any of that income. So they introduced the RRSP spousal rules to allow for that splitting, which is interesting now because that's become a lot less useful because of the new pension splitting rules, which allows individuals to split their RRIF payments. So if you had the same situation where you had an individual with $1 million RRSP and spouse didn't have an RRSP, and then the actual account converted to a RRIF, you'd be able to split that income anyway. So it's really made for these spousal RRSPs to be a lot less useful than they used to be. That being said, these rules can change all the time. So you want to make sure that, you review this with your planner, because if they did remove the pension splitting rules, the spousals would become much more advantageous. So just something to note there. And we talked about the RRIFs converting, or the RRSPs converting. The RRSP will convert immediately after the individual turns 71 and a half. So you have no choice but to take the RRSP and convert it to a RRIF at that point. Okay, so let's circle back around. So what I'd like to talk about now is really just the interplay of RRSPs and expats. So really, this is really relevant to our clients, whether it's individuals moving to Canada from the US and having questions about RRSPs, or individuals already in Canada that have RRSPs, and what does that mean for them? And one of the questions we probably get the most often is, as a US citizen, should I contribute to an RRSP? Or as a US citizen, should I contribute to an RRSP or my IRA? And it'll be difficult to really get through this conversation without a lot of detail, but at the end of the day, the simple answer is, in most cases, for those individuals in Canada, you're not going to contribute to an IRA. First, because you don't get a deduction on the Canadian side for the IRA, and it's not going to be that effective from an overall tax planning perspective. And the RRSP does give that advantage. So at the end of the day, most individuals that are expats in Canada filing and working will contribute to their RRSP as a dual taxpayer. So the idea here, and the way this would look, is you would have the same example: individual earning $100,000 a year, $10,000 contribution. So on the Canadian return, you'd have $90,000 of taxable income. On the US return, you actually don't get the deduction in the US, which can be problematic, but in most cases, because the rate in Canada on tax on income is higher than the rate in the US, it likely won't make a big difference. You'll probably have enough tax you've created in Canada to wipe out all the tax via foreign tax credits in the US. We do see examples of cases where, let's use the same example, individual with $100,000 of income contributes a sizable amount to their RRSP. Let's say they've amassed like $80,000 or $60,000 of RRSP room, and they contribute $60,000 of room or of money to their RRSP, and get a $60,000 deduction on their Canadian return. So now they have $40,000 of income that's not generating very much tax at all in Canada. In the US, because they don't get the deduction, that's $100,000 of income converted to US dollars. You might not have enough tax you've paid in Canada on that income to wipe out the US tax. So that's a case where you might actually have more tax or extra tax that you're paying in the US compared to Canada. Now that also assumes that you don't have carry forwards of foreign tax credits on the US return. And once again, we're not going to get to this in detail, but in a lot of cases, you're going to amass a fair amount of, especially general source carry forward credits that could alleviate that issue, even if you did have such a sizable contribution or deduction amount on your Canadian return. And let's not forget as well, just because you contribute amount to your RRSP doesn't necessarily mean that you need to deduct that amount. So you could contribute $60,000 as long as you had the room. You could contribute $60,000 of capital to the RRSP, but not take a deduction. You could take a deduction for $10,000. You could take a deduction for $30,000. That deduction room will roll over to the next year. But once again, you have to make sure that you have the actual room. If you contribute more to your RRSP than you have room, RRSP contribution room, there's a potential for some really significant penalties, like 1% a month on over contributed amounts, or 1% a month over, they give you a $2,000 buffer. And that 1% a month adds up quickly, especially if the individual has over contributed in 1 year and does not fix that over contribution over a number of years. Like, we've had new clients come in with this issue, and that penalty compounds at a real significant rate. So make sure that when you're contributing to your RRSP, you know what your limit is. So getting back to expats and RRSP. So same individuals, they've contributed their RRSP. Now they have an RRSP, no tax issues because there was enough tax on the Canadian side to wipe out any US tax. So then we just get into reporting. It used to be on US 1040 returns, we would have special reporting requirements specifically to the RRSP. So we had a form 8891. And we still actually get questions about this form, whether we need to file it, how do we file it? People have a hard time finding it. And the reason people have a hard time finding it is because that form doesn't exist anymore. So there's no specific reporting. I mean, it's always good to put treaty elections in your 1040 to ensure that the US government knows that the RSP is a pension account that's deferred for both Canadian and US purposes and under the treaty. So that's a great disclosure to put in your, or required disclosure in your returns. You also will be reporting the RSP on your FBAR accounts and your 8938s. So most expats are very familiar with the FBAR account. That's the form. That's the form that reports all your non-US investment and cash accounts. So the RSP also gets included on that form, and it also gets included on the 8938, which is the foreign disclosure form that's actually in the in the actual tax return. So even though you've gotten the deduction on the Canadian return and not reporting the deduction on the US return, certainly those forms need to include the FBAR accounts, no different than the regular investment or cash accounts. Another question we get often, the RSP doesn't need to get tracked internally. So you're only really, for US purposes, you're only really tracking distributions made from the account. So you're not really tracking the contribution. And then this can be different for those that are not US citizens or those that have moved to the US and naturalized. But for most cases, individuals, US citizens living in Canada, you're only just tracking the amounts of the account on those foreign disclosure forms, and then just the contribution for Canadian purposes. Okay, so if we get, and then let's just finish off with a quick conversation about the transfer of IRAs to RSPs. So this is a question we get so often. Moving up to Canada from the US, I have an IRA. Sometimes it's a small IRA, but in most cases it's fairly large. Should I convert or transfer my IRA up to Canada into my RRSP? And you see this, I mean, people ask this question a lot, so there's lots of people that answer this question online, and there's many articles written about it. And I think unfortunately, because a lot of the answers that are written about this topic are from the perspective of, like, let's say specifically investment advisors that are Canadian-based investment advisors that don't have the ability to hold IRAs. The advice is often try to convert it into an RRSP, but that's the only way that they can really manage these funds. And then the question you really have to ask yourself is like, what is the advantage of doing this? Like, why would you do this? And certainly you want to, you know, if there's some advantages, you want to take you want to take those into consideration, but you want to know what those are before you actually make that move. Because in a lot of cases, especially if the IRA is sizable, and let's just use an example, $1 million IRA, with the same example of an individual earning $100,000 of income, it's going to be very difficult to transfer that IRA into an RRSP, because you'll need to do it over a number of years. The mechanism for doing it, and I honestly wish this would change, but the mechanism for converting an IRA into an RRSP is quite challenging, because what you have to do is you will deregister money from the IRA, you will pay U.S. tax on that money, you transfer it into your RRSP, and then essentially you get a foreign tax credit for the money that you paid in the U.S. Now that's a very simplified way of putting it. So that what ends up happening is you don't end up paying any net tax on that deregistration of the IRA. And that's fine, and it works, and it doesn't work as well when there's penalties, when they're getting deregistered before the penalty age of 59. But it'll take years. So if your income's $100,000, it might take 10 years to do that transfer. So the difference between that and just leaving it down there and slowly drawing from it in retirement, that's a lot easier. Just leaving the IRA up down there, or bringing the IRA up with an investment advisor that can do cross-border investments, both on the Canadian and US side, almost always makes the most sense. It's the simplest thing for clients. Very little reporting. The IRA doesn't even need to get reported on the 1135, which is really nice. Protected under the treaty. So that's usually the best option. But the one advantage that sometimes makes sense to convert the IRA to an RRSP is really the income splitting that we talked about earlier. So under the pension splitting rules, spouses cannot split income or pension income through IRA. So the pension splitting rules allow individuals and there's some age requirements there to actually split pension income. So if you have an individual spouse A that earns $80,000 in pension income and spouse B doesn't have a lot of income, you'll be able to split that income, which is huge tax savings. But the IRA distributions are actually specifically excluded from those rules. So the only way to actually allow for the splitting of the IRA would be to convert the IRA to an RRSP. Eventually that RRSP converts to a RRIF. And then once that converts to a RRIF and it's paid out to spouse, that spouse can then transfer a portion of their pension and they'll be able to income split essentially. So outside of splitting the IRA through transferring to an RRSP and then a RRIF, I don't see a ton of advantages there other than just getting it into an RRSP and not having two separate accounts, but that's a lot of work. Certainly for smaller IRAs, it's often just easy just to do that because then you're not gonna have to deal with a separate account. But for large IRAs, I would almost always keep them intact because it's very tax efficient. And not only that, the IRAs themselves can roll to beneficiaries after death, which we really don't have that option in Canada for RRSPs or RRIFs. Once you pass away, that RRSP or RRIF will get rolled to a spouse tax-free, which is nice. But then after that second spouse passes away, that full amount of RRSP or RRIF gets included in income. Where if that was the same with the IRA, you could potentially pass that down to your kids as an inherited IRA, and it would be tax-free until they started taking distributions over like a 10-year span. So that, I mean, really, at the end of the day, tax deferral is a huge mechanism for tax planning, and that would be a huge advantage there. So once again, unless you feel like you want to split the IRA through a RRIF eventually, it often makes sense just to leave it as an IRA. Okay, so we walked through what an RRSP is, why individuals are incentivized to invest in RRSPs, a little bit of the mechanics, how it works, what it means for expats in terms of disclosures. And then a short conversation about transferring IRAs to an RRSP. So I think we'll leave it there for today. Big thanks for everybody that is watching now and that had watched the previous ones. Love all the great feedback, and thanks again to everybody on the Facebook page for the feedback and all the emails. If you need to reach me, phil@philhogan.com. You can call 250-661-9417 or text works as well. Thanks again, and we'll see you on the next one.